Alright, today's bank is WaFd Incorporated. They recently changed their name this past year from Washington Federal, so really not sure how they pronounce the WaFd, maybe. So throughout I'll probably end up, slipping up and saying, Washington Federal or whatever, but this they recently changed their name to this. And so it has a ticker of WaFd. They're based in Seattle. They've got branches, all over the western side of the U.S. I think in like nine states. Currently have about 210 branches, so pretty big bank. They also have some preferred shares at fixed rate of 4.875%, and it's publicly traded with a ticker of WAFDP. So you can look at that if you want to as well. It's pretty low yield or payout rate right there. I'm sure the market price has adjusted to make the yield be more in line with the market now, but a fixed rate of that low into perpetuity might not be the best investment, but it is definitely good for Washington Federal, paying such a low rate for forever, potentially. So anyway, we can look at the Yahoo Finance page. We can see the normal trend that we've been seeing in all of the charts over the past year. It's kind of some ups and downs throughout the year. It's got a market cap of about 2.3 billion, so it's a little bit larger than our average bank of the publicly traded community banks we have. It's about 340 or so. So it's a little bit higher than the normal range, but so good sized bank. I have a PE ratio of 10.95. That's not too bad right now. A little bit less than 10% of an earnings yield, so might be kind of at the bottom of our normal range. An okay dividend yield. So it seems like it's priced a little bit expensive or average compared to the earnings currently. So if we come over to the statistics, we can see also the price to book about 0.89. That's about in the normal range of what we see. Somewhere between like 0.9 and 1.10 is usually what the price to book is normally. So that's probably about average as well. It looks like the return on assets, 0.71%. That's pretty low. We usually see somewhere between 0.9 and 1.10. The return on equity is also a little bit low. I guess it depends on how Yahoo Finance is calculating this. Like, what is the denominator part of that ratio? The assets or the equity, because and we'll get into this a little bit later, but they recently acquired another bank, and so I don't know if this is like, if the assets in the denominator is a weighted average of the period that they're doing earnings, or if this is the new asset value with the combined bank, which would have a much larger denominator and perhaps skew this lower. So not sure, but we can dig into things in a bit and see kind of how does the profitability look. This might be kind of misleading from the way they calculate it. Anyway, so let's start diving in. I want to first say that this is probably going to be a really difficult one to analyze, or at least come to a definitive conclusion, because of what I just said about how they recently acquired another bank, which was Luther Burbank Corporation out of California, and the bank's quarter end, at least Washington Federal's, is March 31, 2024. Luther Burbank came on March the 1st. So, and before I get into that, another nuance is that the year end for Washington Federal is September 30th, I believe. So everything here, at least in the income statement, is a 6-month basis. Where normally if we were looking at March 31st, it would be 3 months, right? So, but since their year end is September, we've got to pay attention to, hey, this is 6 months of information. So whenever we're looking at the earnings here, due to the acquisition that started March 1st, then that means there was 5 months with just Washington Federal by itself, and then 1 month with Washington Federal plus Luther Burbank. So we're going to make a few adjustments to things, and also kind of be cognizant of that when we look at certain ratios that compare income to assets or equity or anything like that, because now the assets are the combined bank, but the income for most of the 6 months was just Washington Federal. And on top of that, Luther Burbank only represents about 20%, about 20% of the combined bank now. So it's not like it should have a huge effect on the earnings on a combined basis. It's basically adding 20% of a bank to the thing. So anyway, we're going to dive into a lot more of that in detail. I just wanted to kind of give a heads up of kind of the difficulties of what we're going to encounter when we come into this. I think the balance sheet is going to be sort of easy to analyze, or at least we'll be able to analyze it in line with the way that we usually look at it, because we'll be able to see the combined bank now. But the income statement, we're going to need to adjust some things to match, how do we expect the combined bank to perform going forward? And so that's going to be the difficult part. So anyway, so let's take a look at the actually maybe the first thing we can do is jump down into the footnote about the business combination. That way you can kind of have an idea of what transpired before we maybe jump into the balance sheet. But yeah, so they bought Luther Burbank and absorbed it into Washington Federal. Before the transaction, Washington Federal had 64 million shares, and then they issued 17 million and paid them to Luther Burbank's shareholders. So now there's a little over 81 million shares outstanding, and that's where I was coming up with 21% of the company is basically Luther Burbank coming in, and 79% is Washington Federal originally. So based on the market price of Washington Federal on that day that it closed, it's a purchase price of about $465 million for Luther Burbank, and so now the market cap of Washington Federal together is about 2.3 million, which is what we saw on the Yahoo Finance page. Yep. So we added about 465 million of market cap by issuing these 17 million shares, bringing on Luther Burbank's net assets. And so we've got, whenever you're bringing all this on, you convert it to fair value. The assets at fair value, liabilities at fair value, and then whatever that difference is, you put it to goodwill. So we recorded about 105 million of goodwill. So if you think about this, and from the perspective of how much money did Washington Federal pay to Luther Burbank relative to the net assets, that the fair value of the net assets we get, and they basically paid 1.29 times the fair value of the net assets, which is actually it's a really cheap price. As we've seen, the market prices of a lot of the banks that we look at is somewhere between 1.5 and 2 times the fair value of the net assets. But this acquisition ended up where they paid about 1.29 times. So that's a really good buy, I feel like. So it's basically they paid $465 million and got $360 million of net assets out of it. So that's a pretty cheap price relative to most banks. So anyway, that's how things came about. It closed on February 29th, and so that's why I'm saying March the 1st is the first day that the operations of Luther Burbank are part of these financial statements. But the 6-month financial statements go from October 1 through March 31. So only one out of the 6 months has Luther Burbank in it, but only 20% of the company is Luther Burbank. So so some things to consider as we dive in. But anyway, so let's go back up to the balance sheet, and you'll be able to see first off how most all of the accounts increase, and that's because September 30th, no Luther Burbank. March 31st, now we've added Luther Burbank's assets and liabilities and stuff. So, and if you were to compare then to now, basically the net assets didn't change much. We issued all the equity, put on the assets and liabilities, and whatever the difference was is the goodwill. So that's sort of how it works. But anyway, so let's start going through things and see how it looks. All right, so we've got about $1.5 billion of cash. That's about 5% of the balance sheet. It's pretty average. We usually see somewhere between 4 and 6%, so it's right in the middle. We have some securities here. These are the next level of liquidity, I suppose, of the assets. But these together get us about 10% of the assets, 9.5% or so. And that's a little bit on the low end. We usually will see somewhere between like 12 and 18%. So about average amount of cash, a little bit less amount of securities. So maybe this bank might be a little bit on the lower end of the liquidity than what our normal banks might be, but they still have a substantial amount of securities. So they also have the first thing I want to touch on is the loans held for sale. They've got about $3 billion, and so as part of the acquisition, they decided to sell a portion of the loan portfolio. And they issued an 8K after the issuance of the 10Q, and ended up selling these to Bank of America at about 91% the amortized or the remaining principal balance on these. So slight loss, I think, which will come out in the next quarter's financial statements. But so yeah. These are, supposedly at fair value, because whenever they bought the securities from Luther Burbank, or Luther Burbank shareholders, they basically have to convert them to fair value at that time. So presumably there would not be a loss recorded on the books. I guess I said that wrong a second ago, but because they will be at the fair value that they would sell them at. Presumably, if they estimated the fair value correctly and everything. So anyway, so those are going to go away and become cash, I suppose. So very liquid source of assets here that will be converted to cash next month. So maybe that kind of shores up where the securities were a lower proportion perhaps, and give us some more cash, and that'll really make a solid liquid balance sheet there. Anyway, so then we've got some loans here that are held for investment. They end up being about 70% of the balance sheet, and that's pretty average. So So really we're looking here at a very average asset side of the balance sheet, and especially once the loans held for sale get converted to cash in the next few months, or at least in the next 10Q, we'll have a lot more cash or securities depending on what they decide to do with it. All right, so coming down to the liability side, we can see they've got about $21 billion of deposits. That comes to about 80% of the balance sheet, which is pretty average. They've got about $5 billion of borrowing, and most of those come from FHLB or Federal Reserve borrowings. They got a couple million from that they assumed from the Luther Burbank transaction. They also assumed a couple of these are trust preferred securities, I believe, and then a subordinated note here. So they assumed a little bit of debt from Luther Burbank, and now this 5.3, or all this debt together is about 20% of the liabilities, and that's a pretty high amount. And so we'll see a little bit later that a lot of these borrowings are at floating rates, or at least like repriced pretty soon. So that's some interest rate risk there, and some more expensive funding sources for sure. So we might end up seeing a little bit higher interest expense. I'm not sure. Once we get into the income statement, we'll be able to tell. But as far as the deposit accounts go, I don't like the way that they've split this up, because it's a little bit, most banks' balance sheet will present this as non-interest bearing deposits and then interest bearing deposits. But they've, these transaction accounts have included all, perhaps checking, savings, money market accounts type of thing. So we have to go down into the footnotes and dig out, well, how much of it is interest bearing, how much of it is not interest bearing. So if we go, and it's actually down in the MD&A. So anyway, we got $2.5 billion of non-interest checking, and then the rest of it here, which ends up being about $18.9 billion. So we see that about 9% of their liabilities is non-interest bearing, which is a pretty low amount. Usually we see somewhere between 20 and 25%. So, not only are most of their deposits yielding interest expense, but also they have a pretty large amount of debt, which we saw that is also yielding at higher cost than perhaps even the deposits are. So we'll be able to see a little bit more of how that works once we dig into the footnotes and MD&A and stuff. But as I could see, the asset side's pretty normal, pretty average. But I could see the liability side being pretty expensive for them. So now let's take a look at the income statement. Another thing to note before we dive into that is they do, we talked about the preferred shares that pay out as well. So that's, they're at a fixed rate. So, it's basically locked in that rate forever. And so it doesn't reprice. So that's a pretty good deal, I feel like. So anyway, so let's dive in. So we've got 3 months financials here and 6 months here. We're going to be basically exclusively looking at the 6 months so that we have kind of a longer time period to see. And so as we talked about, this 6 months right here is basically 5 months of just Washington Federal and 1 month of Washington Federal plus Luther Burbank. So if we're analyzing this company with the goal of seeing like what does the profit of the combined bank look like going forward, then we're going to have to consider what was the income of those other 5 months of Luther Burbank and put those in here, right? And then compare it to the market cap or the assets or anything like that. Otherwise, this is really misleading because we only have 1 month of Luther Burbank, and so this net income it's going to appear really, really low, right? So fortunately, the company accountants have done the heavy lifting for us, and so if we go down to the footnote about the acquisition, they have some pro forma financials. And so what they've said is, what they've put together is income of the combined companies if they had been combined on October 1st, 2022. So then we can basically see what would the past 6 months have turned out to be had the companies been combined for the entire 6 months. And so what it says is 351 million of net interest income, non-interest income of 30 million, and 120 million of net income. And this is also excluding 40 million of merger-related costs, which seems like a lot of money to spend on the merger, 40 million. But as it is, they do say 25 million for the 6 months. So presumably this 25 million was for 5 months of Washington Federal and then 1 month of Washington plus Luther Burbank, right? So does the 40 million seem too far-fetched if we add in another 5 months of Luther Burbank? That would be another 15 million to get up to 40. Seems pretty reasonable if the 25 million is there. So anyway, that means before this, it would have been about an $80 million net income before adding back the 40 million merger. So I don't know if that's a little confusing or not, but so anyway, so keep in mind 350, 30, and 120. So if we go back up to the income statement, which is 5 months Washington Federal, then 1 month combined, then we have 310. So the pro forma said about 350. So that's not too unreasonable to go from 310 to 350, adding 5 months of Luther Burbank, which is 20% of this company. So that could analytically make sense. Other income, 28 million. I believe the pro forma said 30 million. So Luther Burbank's adding just a little bit to that. Seems like it could actually be a little bit higher, but yeah, that could make sense. And then net income here is 74 million. The combined, they say, is 120, or the pro forma at least. So that's adding a lot. So it's adding. So if we go from 74 to 120, that's adding 46 million. But we're taking out 40 million from the merger-related expenses. So that's actually only about a $6 million increase that's coming from Luther Burbank. So I feel like that's a really conservative amount, perhaps. 5 months of Luther Burbank adding only $6 million of net income. I feel like it's probably good. It could possibly have been more. Anyways, to corroborate a little of this, I wanted to also look back. So they issued an 8K before the issuance of these financial statements with some pro forma figures, and so wanted to compare what's here now to what they put together then, and we can kind of decide if that makes sense or not. So Total interest income, let's go down to 6 months ended March. So I'm going to be jumping back and forth perhaps. Actually, so let's go back to the income statement and we can compare. So income statement for Washington Federal itself for 6 months, 605 interest income, so 605. So maybe all those match. So if we combined is 67, 67, yeah. So this is basically these financials that we're looking at for 5 months Washington Federal plus 1 month combined. So we're going to add another 4 months or another 5 months of Luther Burbank to this to get to a combined pro forma. And all right, so what they're estimating in this 8K was 68 million pro forma combined. But remember that actually let's use the 76 million before the preferred dividend, so 76 million. But this does not include the adjustment for the merger related costs. So if we add 40 million to this, that's 116 million. So what the pro forma and the financials had said was 120, I believe. So that's actually really close. Yeah, 120.1. So I would say this is pretty consistent with this. So we could probably consider, these net interest income, net interest expense, or yeah, interest income, interest expense, all these figures to match with what we should put into our income statement whenever we're considering, price to earnings, return on assets, that sort of thing. Anyway, so let's do that then. So the pro forma company, this is assuming that the entire 6 months was the combined banks of Luther Burbank and Washington Federal. So we got about 770 million of interest income. So that's about 5.46% return on assets, or at least interest income relative to assets. That's a little bit on the higher end. We normally see somewhere between 4.8 and 5.2. So they're really yielding a little bit more than what most banks are. On the interest expense side, we've got their customer accounts, which would be savings accounts, money market, interest-bearing demand accounts, such so 320 million. That ends up. Let's look at the total. So 420 million. That gets us at 3.14% of assets, and that's really, really high. Normally, we see somewhere between 1.5% and 2%. So, as we were talking about how they have a lot of high cost funding as well as a low amount of non-interest bearing deposits, kind of makes it to where they've got a pretty expensive interest expense here. So, and then we've got, so that equates to 349 million of net interest income. And that's actually pretty close to what they had in here. So 351, pretty similar to 349. So that's about a 2.32% of assets. So that's a pretty low net interest margin. Normally we see somewhere around 2.8 to 3.2. So them having a 2.32% net interest margin is pretty low. And it's mostly because of the high cost funding on their balance sheet, I believe. And then non-interest income, 30 million. That's a really low amount as well, especially for such a large bank. You would expect that they would have a lot more non-interest income, but I suppose maybe they don't have a lot of the ancillary services like the wealth management, insurance, and all that kind of stuff. So That equates to about 4% of revenue. Usually we like to see 10 to 14%. So they're really kind of missing out on a lot of extra revenue there. But, they also have a lot lower expense here. So 280 million of non-interest expense. And then keep in mind, like about 40 million of that is supposedly merger-related costs. So, this figure is actually about 240 million. So 240 million ends up being about 30% of the revenue. So they're saving a lot on the non-interest expense, which perhaps is hopefully mitigating a little bit of the lack of non-interest income here. Anyway, so if we were to come down to this, after the income taxes, we have about 76 million of net income, and minus the preferred dividends, we end up with about 69 million of income available to the common shareholders, which is what we would be. And so taking the 69 million and adding the 40 million of merger-related costs that are in this that aren't going to be happening going forward, presumably, that gives us about 109 million net income, and it's about a 0.72% return on assets, return on the assets as of March 31st. So that's a pretty low amount. We normally see somewhere between 0.9 and 1.10% return on assets. So 0.72% is really, really low. Return on equity about 8.28%. So that's a return on the March 31st equity. And that's pretty low also. We normally see 9 to 12%, something like that. So, we could say that the combined bank perhaps might not be within the normal range of profitability for most banks going forward. And it looks like it's mostly because of their more expensive funding sources, but also not a whole lot of non-interest income on there. I feel like if they added some non-interest income, that it could really help with their profitability. But if we're going to compare that to the market price of the company, that would put us at about 9.33% earnings yield, which is on the lower end of the range. We'll normally see somewhere between like 9 and 11% earnings yield. So that 9.33% is within average, but kind of on the lower end of that. So when you're buying the earnings of this company, you're buying a less profitable bank than what most banks are, but or what the average bank is. And but the price of the bank has come down a little bit to compensate you for that. So anyway, I think that was probably the heavy lifting, the hard part of this. So kind of converting everything into the pro forma to get it in a place where we can project what's the profitability going forward. And so I think we did a good job of laying that out. So let's go into more of the footnotes and we can get some more details about how the bank operates and what all it's composed of. So, as we talked about, they're in Seattle, mostly in Washington, but they've got 200 branches across Washington, Oregon, Idaho, Utah, most of the western states. I think adding Luther Burbank added several branches in California. So we can kind of scroll down a little bit further past the acquisition. I think we've kind of gone through the acquisition in enough detail. And so their first footnote here goes through the loans. We can see that majority of their loans are commercial. They got some multifamily, commercial real estate, really across the board. And consumer loans, they've got a really large amount of 1 to 4 family residential. This is about 39% of their loans, which is it's an unusually high amount. We normally might see somewhere between 17-24%, something like that. So they're really highly allocated to residential loans. So I would think that would give them a lower yield on those at least. But they've also got a similar percentage of all of these, multifamily, commercial real estate, C&I, construction. So the big determining factor of the risk and earnings on these is going to be coming from the single family, which typically have lower risks, but also lower yields. So it'll be interesting to see how that plays out in the yields. And we looked at the net interest income was, or the interest income was a bit higher than what most banks is. So it'll be interesting to see once we get into the MD&A, what is it that's giving them such a higher yield. But we can also go down and see the credit quality. They've got about 60.8 million of non-accrual loans. That's a pretty small amount. It's about 0.29% of loans. Normally we'll see somewhere between 0.3 and 0.5. So they've actually got a really low amount of non-accrual loans, which is great. Past due loans is about 76 million, it looks like. That's also a really small amount, 0.36%. Normally we'll see somewhere between 0.5 and 0.8. So, loans that are past due or non-accrual are they've got a pretty low amount of them. So, perhaps the credit quality of the loans is in good shape. It looks like the highest is the single family residential, which is where their portfolio is most allocated toward. So 0.3%, I feel like is perhaps a little bit higher than what we might normally see, but not outrageous. And then we've got what they used to call TDRs. So modified loans here's about 50 or 64 million in the past 6 months. So that's a pretty low amount as well, 0.3%. So not too bad as well. And then coming down into the classification of the loans, we usually like to add up the classified loans, which would be the substandard and worse. And we can kind of see how they might perceive the credit quality of the loans that they have on their books. So multifamily 31.8, commercial real estate 115, C&I 119, so on and so forth. So for the total commercial loans, they got 286 million of classified. So these are the ones that have some sort of an issue where they're more than likely not going to be paid back the full amount of the loan. Then they've also got the consumer ones down here, which we usually consider the non-performing ones, which is basically anything above 90 days past due. Not as much there, about 16 million. Interesting. So single family residential, 16 million, 90 days past due. What was it on the 90 days past due chart? Yeah, 15.6. Okay. Thought there might have been a discrepancy there, but not. So anyway, so if you add all that together, the commercial plus residential classified loans, that gets us about 307 million classified loans, which is about 1.36% of the loan portfolio. And that's pretty much in the middle of what we normally see, somewhere between 1.10, 1.65%. So they've got a pretty normal amount of classified loans. So we can come down to the allowance and see if they've got a normal allowance. So we've got, make sure this is 2024, yeah. So in total, 201 million. So split up between all these different categories. So 201 million as a percentage of loans is about 0.89%. That's on the low, it's outside of the normal range. It's really, really low. Most banks we might see 1.10 to 1.25% reserve relative to loans. And so this bank has 0.89%. Leads me to believe that they might have a little bit lower reserve than perhaps what they should. Part of that might be due to the purchase accounting of Luther Burbank, where they, whenever they bought the loans and securities, in the first place, they have to convert them to fair value. So, perhaps there's something there. Maybe that's not it, but I feel like that reserve is pretty low relative to the overall balance of loans, but also relative to the classified loans, because as we saw, the classified loans amount to 307 million, right? And those are loans that are likely to have at least some loss, and it's just not going to all be a loss, but usually we'll see most banks have reserved at least 93% of the classified loans. But in this case, these guys have only reserved 66% of the classified loans. So I feel like there's either in the future they're going to have a higher reserve, or they're going to have some write-offs that's going to directly hit the net income. So there's definitely a credit quality risk here. I feel like the credit quality of the loans themselves is about normal. It's about average. But the reserve that they have is not average. It's below the average. So they're either going to need to make a higher reserve or write off some of the loans in the future, is what I would expect. So anyway, so moving on from there. Next one is the fair value measurement. So this is comparing the fair value to what is carried on the balance sheet. If we were to convert all of these, available for sale is at fair value anyway. So it's basically going to be the held to maturity ones, 407 versus 457, and then the loans. From 20.2 to 20.8, and then also the liability side of the balance sheet for the time deposits, as well as some of the ventures and whatnot. But anyway, so if we were to put all this, convert all of the balance sheet to a fair value amount, we would reduce assets by about 600 million, and we would increase liabilities by about 11 million. So all of that combined reduces our equity balance by about 21%. So the balance sheet, as it was, reduces the net assets by 21% when we convert them to a fair value, and that represents about comparing to the market cap and excluding goodwill and intangibles. That gives us a market to tangible fair value of about 1.49, which is it's a really cheap price. So our range is normally like 1.5 to 2.5. So having a 1.49 price to buy the net assets of the company is a pretty good price. It's pretty cheap. And also, if you compare the fair value of the net assets to the fair value of the assets, which we kind of use as a sort of a capital to gauge the value of the capital relative to the assets, is it's about 6.38%. So that's right in the normal range. We usually see something like 5 to 7% for that. So it seems like it's about average capitalized as well. So you're really buying the net assets of the company at a really good price, and but also the company itself is adequately capitalized, it seems. So, even if we were to look at the company at just the balance sheet, assets to equity is about 10 times, which is pretty average for what we normally see anyway. So it's about an average leveraged bank. All right, so let's keep going. This is a little bit more about the securities. As we see with most banks, most securities are mortgage-backed securities. They've got 1.3 billion plus 407 million. And then they've got a little bit of agencies and asset-backed corporate. So really the allocation to the securities is very, very average, very normal. It is nice to see some of these securities yielding about 6%, and especially at 6% for such a long term. So that's awesome. So just from this, it's hard to gauge the term structure of the securities portfolio, but because most all of them are mortgage-backed securities. But once we get into the call report and stuff, we'll be able to see kind of what's the repricing of these. And that'll help us determine interest rate risk, along with with the loans as well, or the repricing timing of loans. But if we keep on going, we've got some unrealized losses here, and it's pretty customary for most banks. And interestingly, we've got a lot of derivatives as well. If we look at the notional amounts of the derivatives, we can kind of ignore these. These are the client swap program hedges. So, what they might do is initiate a hedge with their customer or with their client, and then also at the same time initiate an opposite swap with a different counterparty, so they net themselves out, right? And that's why we might see here, fair value of an asset, the derivative asset, 63 million. And the liability 64 million. So there's not that much of a effect. They're intended to offset each other, right? So the ones that we would be concerned about would be the hedges. And so we've got fair value hedges here that hedge the loans, and then some cash flow hedges that hedge the borrowings. And those are all hedging the risks that I like to see. The fair value hedge converts from fixed rates to variable rates. So for loans, if interest rates go up and they're tied into these fixed rate loans, then they don't get to capitalize on when interest rates go up. So by hedging with fair value hedges, they can convert that fixed rate to a variable rate, and then be able to get the variable rate as it increases. And on the borrowings, it's the opposite, right? They have or borrowings on a cash flow hedge. So they have variable rate borrowings, which, as we discussed earlier, most all of their borrowings are at variable rates, which is really, really risky. So what they've done is they've hedged 1 billion of them by converting those variable rates to a fixed rate, and swapping a variable to a fixed rate. And so that mitigates the interest rate risk if interest rates were to go up. So those I think are really going to help out the interest rate risk and the repricing risk of both the liabilities and their assets. And also we talked about the loans held for sale is about $3 billion, which is also going to be sold, and then it will reprice into whatever they decide to invest it in, whether loans or securities or interest-bearing cash. So anyway, so we add these derivatives into our calculations for the repricing interest rate risk as well. So I feel like they're doing a really good job with their derivatives there. And what else do we got? So now we're down in the MD and A. So we can learn a little bit more about how the yields are. So, this is the 3 months. We're looking at 6 months. So here's 6 months. So keep in mind, this is basically 5 months of Washington Federal by itself and 1 month of Washington plus Luther Burbank. So this isn't the way that the combined bank might look, but I think it's going to end up pretty similar. When they do these average rates, it's a weighted average. So I think it should adjust for the amount of assets on the balance sheet in each month. So should be about similar. It looks like we had similar calculations for this based on whenever we were comparing the income statement or the pro forma income statement to the assets. So I think this is going to end up about the same. Yeah, so we've got 5.49%. That's a little bit higher than our normal range that we typically see. We normally see somewhere between 4.8 and 5.2. So it's pretty good. The loans is the biggest component here, so we're getting about 5.59% on our loans. That's pretty much in the average of what we might normally see. So what's really helping, I think, is the securities. So 5.81% on the securities. That's a lot higher than what we would normally see. Normally we're about 3.5%. So they're earning some good money on their securities. I think this is also invested cash as well. They combine those two together. But it's really the securities portfolio that's helping them earn a higher yield than most banks do. And then, as we talked about and we saw earlier, they've got some pretty expensive funding sources, most of which are interest bearing. So they've got 3.24% yield on those interest bearing liabilities, and that's really, really expensive. Normally we're seeing somewhere between like 2.2, 2.7, somewhere like that. So, not only are their funding sources yielding higher than we want them to, but also most of their funding sources are yielding. So that also exacerbates, which kind of isn't present on this because it only shows the interest-bearing liabilities or compares to the interest-bearing liabilities. So anyway, so we get a net interest margin of about 2.81%. That's pretty low. We normally see somewhere between like 3 and 3.5%. So 2.81 is a pretty low percentage of net interest margin, and we saw that when we were looking at the pro forma financials as well. So that's the principal reason why they're not making as much money as what most banks make, or the average bank makes. And in conjunction with them not having as much non-interest income as well, which isn't present in this. So anyway, we can look at the liquidity and capital resources here as well. From a liquidity standpoint, if we were to take the cash and add it to unencumbered securities, we would get about 11%, or that total would be about 11% of deposits, which is on the lower end. We normally might see 13 to 18% for that ratio, but as we talked about, they've got about $3 billion going to land in cash soon once they sell the loans held for sale, and they issued an 8K that said that ended up happening. So is not something that we expect and hope for. It did happen. So they have an extra $3 billion that landed on the balance sheet, which I think would help. That would boost that ratio to over 20%. So I feel like with that, they really have a good liquid balance sheet. As we talked about earlier as well, from a overall capital standpoint, the fair value of their net assets is a good percentage of the fair value of their assets. So they're really, their equity is really well capitalized as well. So I feel pretty good about the liquidity as well as the capitalization of the bank. They also have access to wholesale funding like FHLB and the Federal Reserve Bank, which they have a lot outstanding with them, a little over $5 billion we saw, but they've got the ability to borrow a lot more than that. So anyway, I think liquidity, fair values, all in a good place. And if we look at the regulatory ratios, we've got a leverage ratio of about 9.68%. We've got common equity tier 1, 10.07, tier 1 risk-based, total capital ratio. So all these are about on the lower end of the range of the average bank. But they're way above the minimum requirements to be considered well capitalized. So I don't see it as being a problem. I feel like the other things that we looked at are really good evidence that the bank is able to carry on its operations and doesn't have much risks in that regard. Its common equity ratio is about 8.7%, which is a little bit low on the range, but I don't think it's some kind of catastrophic problem. So I do think the bank is really well capitalized, has really good liquidity, and able to carry out its operations. So we can go through a little bit more of the MD&A. We talked in detail about all this stuff, so I think we can kind of pass on through, because we were discussing it as part of our footnotes. I also wanted to touch on the net interest projections for different movements in interest rates. I think I missed that part. It's a little bit hidden in their financial statements. They do, in their financials they do a lot more explanations rather than kind of tables, which makes it a little bit difficult to find things we're looking for. Oh, here we go. It's kind of buried up here in this. So net interest income sensitivity. Yeah. All right. So what this tells us is that if there's an increase of 200 basis points, we should expect 9.3% increase to net interest income, and if we've got 300 basis points increase, 100 basis points increase in long-term rates over 2 years, we should expect 3.1% in the first year and 8.1% in the second year. So basically, if interest rates go up, we should expect net interest income to go up, which would make, at least in the first year, the bank to be have an asset sensitivity, which is the direction I like it to be, at least in this environment. There's a lot of talk of rate cuts and stuff like that, but either way it goes, I feel like a bank can operate easier if they're a little more asset sensitive, because banks are naturally liability sensitive over the long term, right? So if you're more asset sensitive, no matter which way the interest rates go, you can make some money. So anyway, if we were to look at the call report and try to calculate some kind of repricing risk, repricing ratio, our calculations also come to being a little bit asset sensitive over the next year. Not egregiously so, but just enough to make us not be in a tough spot if interest rates were to go up. So, and the reason for that is mostly because a lot of the loans reprice pretty quickly. Actually, a lot of securities reprice real quickly. So $1.3 billion of the securities reprice within the next year. That's about 44% of the securities. So that, normally it's, 8 to 15% or so. So they have a lot of securities that are repricing within the next year. So they'll be able to reinvest those at the higher rates now. They're also selling the $3 billion of loans that they can reinvest at the higher rates now as well. So, I feel like in the coming years, they will be able to really make some more money as a lot of these loans and securities cash comes in. But another big hindrance is they got about $4.5 billion of debt, partly from the FHLB and FRB, but also from trust preferred securities and the subordinated debentures that reprice within next year as well. So they might consider paying off a lot of that stuff as they sell the loans, as they have some of the securities come in. By paying off the debt side, they might get rid of a lot of the high cost debt that they're having to pay. That's going to be even more costly once it reprices. So, but that's up to them. I don't know which direction they will go. But anyway, so that is it. So Washington Federal. That was a little bit longer one. It was a little bit more complicated because we had to deal with the business combination. But I think we did a pretty good job of projecting how things might look and get a good feel for whether this is a good investment or not. So to recap, we've got from a profitability standpoint, I feel like it's not as profitable as what we might see for the average bank, mostly due to the liability side of the balance sheet being really expensive. So, and then considering a lot of the risks, as far as the interest rate risk goes, I think that there's not much there. I think they're in a good the structure of their balance sheet, I think, is good, and especially once they have a lot of these securities paid down, and then also sell the loan portfolio that's being held for sale at the moment, they'll be able to reinvest that at higher rates, or even pay off the really expensive debt, and then I think they have an opportunity, I think, to be making more money than what they do now. But we'll see. So as far as the capital risk goes, as we talked about, I think they're good there. They basically, the fair value of their net assets, I think, is robust. They also have some good liquidity, especially once they in the next quarter, once everything reprices and they sell the loans and everything, they're going to have some really good liquidity. As far as the credit risk goes, that's as we talked about, I feel like they don't have a large enough reserve to support any potential loan losses, and that eventually they're going to need to increase that reserve or write off some of the loans. So as a recap, good things are the interest rate risk and the capital liquidity. The bad things are low profitability and credit risk, not enough of a reserve on their loans. So how does that look in regard to price? If we looked at price relative to the earnings of the company, which we saw is the earnings yield would be at kind of the lower end of the normal range. I think it was like 9.33%. I feel like that's really low given the risks that we have for the credit quality, as well as yeah, the company just being unprofitable in itself. So um, I think that's a pretty low yield for some of the risks that we're looking at. As far as the pricing on the value of the assets, I think it's a really good price. But related to the credit quality, the credit quality is a little bit more it's below average, and so I would expect the market price for the bank to compensate me a little bit for that. And so as it is, the market price is lower than average as well. So, or at least in the lower end of the average. So I think that the market price needs to come down a little bit to compensate me the credit risk before I would buy at this price. And, also, the risk of the business combination itself. Usually there's a lot more costs that go into things to sort of integrate the companies together, and so there's probably some additional ancillary costs related to that coming down the pipe that will reduce its profitability as well. So there's just a lot of uncertainties with the combined company. We're basically using pro forma information as it is, which is an uncertainty. It's an estimate. So I would want the market price to be a little bit cheaper for me to be comfortable buying the company. Maybe when we look at it again next year, we'll have a little bit more certainty about how things look, and we can kind of reassess things at that point. So anyway, thank you for listening. I know this was a longer one, but let me know kind of what you think about things in the comments, or if you have any additional opinions, opposing, corroborating opinions, whatever. I'd be interested to hear what you think about it. So thank you for listening.